They thought the shock would come from Silicon Valley. Instead, it came from the bond desks, when traders watched $190 billion in new AI debt hit the market and realized the system wasn't absorbing it. It was drowning in it. At the same moment, energy officials were quietly updating grid warnings because AI data centers were pulling so much power that utilities said demand was, outpacing entire cities. And then the water numbers dropped. S&P confirmed nearly half of America's new AI facilities sit in zones already running out of groundwater. That's when the fear hit. This isn't a tech boom, it's a three-front collision. Credit cracking, power straining, water vanishing. And honestly, nobody's prepared for what happens when all three break at once. Analysts who initially framed the issuance as a simple reflection of the AI boom realized the underlying physics were far harsher. Every bond offering represented another data center, and every data center represented thousands of racks of GPUs, pulling megawatts of electricity and millions of gallons of water every year. The financial expansion was mirrored by a physical expansion so resource-intensive that agencies were already warning the grid load could break past anything seen in decades. The U.S. Department of Energy projected that data center electricity consumption in 2025 and 2026 would hit record levels as AI workloads multiplied. Utilities watching that surge warned regulators that peak load stress might hit faster than planned transmission upgrades could compensate. S&P Global Sustainable 1 released a 2025 assessment showing that nearly half of all data centers built this decade were in regions classified as vulnerable to water scarcity. For states like Texas and Arizona, where drought cycles have grown more severe, water planning authorities stated that facilities could consume millions of gallons per year, large enough to push local basins beyond sustainability thresholds. Bloomberg published case studies showing that in several counties, server farm withdrawals exceeded what nearby communities used in months, sometimes in weeks, creating friction with residents who already faced seasonal rationing. As the physical strain mounted, credit desks began receiving instructions to reevaluate exposure to the hyperscalers. The large-cap tech firms, Amazon, Meta, Alphabet, Microsoft, and Oracle, had collectively raised nearly $100 billion in new bonds in 2025 specifically for AI infrastructure projects, according to Reuters. Industry estimates cited by the Wall Street Journal put their combined data center investment plans near $400 billion for the year, a figure so large it approached half of all new investment-grade corporate issuance expected in the United States for the entire cycle. Fund managers told the Financial Times that this level of concentration threatened to reshape the structure of the corporate bond market as liquidity flooded into just one sector at the expense of all others. Banks noticed the imbalance first. Capital that would normally flow into manufacturing, construction, transportation, or small business lending was being redirected toward the AI infrastructure pipeline. Loan officers told Bloomberg that traditional borrowers found themselves paying wider spreads because tech sector demand was bidding up the cost of debt across the board. LSEG data confirmed investment-grade spreads hitting their widest levels in months by late 2025. Mid-sized firms without top-tier credit ratings began delaying expansions, citing more expensive financing. The U.S. Travel Association reported that tourism sector businesses were seeing higher borrowing costs at the same time that cross-border travel volumes were softening, compounding stress for service sector employers. The broader economy felt the shift almost immediately. Mortgage markets reflected higher funding costs as money market conditions tightened. Wall Street Journal reporting highlighted that banks were increasingly relying on the Federal Reserve's standing repo facility on days when liquidity thinned, particularly during heavy Treasury settlement periods. Federal Reserve officials acknowledged in public remarks that intermittent surges into both the repo and reverse repo facilities suggested strains emerging in what had been considered an ample reserve system. The Fed's balance sheet, still above $6.5 trillion, had become more difficult to align with short-term rate stability as cash moved unpredictably between the banking system and capital markets. Treasury officials monitoring the money market plumbing flagged the possibility that if AI-driven issuance continued at the current pace, dollar liquidity could tighten beyond what stabilization tools could offset. Bloomberg analysis noted that demand for Treasury bills occasionally spiked during AI bond offering windows, an early sign of liquidity fragmentation. Hedge fund managers told Reuters that they were monitoring cross-currency basis swaps for signs that offshore dollar markets were beginning to feel stress, a pattern associated with the early stages of liquidity squeezes. Despite the warnings, AI investment continued accelerating. Manufacturers supplying power distribution units, industrial cooling systems, and high-density server casings reported record backlogs. Semiconductor firms, already limited by production constraints, announced further price increases for advanced accelerators. Industry data from Taiwan and South Korea, cited by the Financial Times, showed that global shipments of AI-grade compute units were expected to grow more than 40% year over year. Analysts noted that this rate of expansion meant the associated credit demand could rise proportionally, intensifying pressure on bond markets. Communities near major buildouts were already hitting resource limits. In Central Texas, water authorities told the Wall Street Journal that aquifer declines were accelerating in areas where multiple hyperscale centers were under construction. County planners in Arizona told Bloomberg that projected electrical loads for data center clusters were exceeding previous forecasts by double-digit percentages, forcing utilities to revisit long-term grid expansion budgets. Rural counties in the Midwest, where some operators plan to tap surface water sources, reported rising concern about ecological impacts. S&P Global Sustainable 1 emphasized in its 2025 modeling that water depletion risks would become more acute as more facilities concentrated in already stressed basins. The contradiction was now impossible to ignore. The same infrastructure driving the AI boom was straining the resources needed to sustain it. Bond issuance kept rising even as utilities warned of load constraints, municipalities warned of water stress, and lenders warned of concentration risk. The Financial Times reported that several large pension funds quietly capped their exposure to AI-linked corporate bonds, citing concerns about macro liquidity and sector over-reliance. Credit strategists at DoubleLine told Reuters that AI-linked debt could reach $1.5 trillion within 5 years, potentially exceeding 20% of all outstanding investment-grade corporate bonds. The historical parallels worried regulators. Bloomberg recalled the telecom build-out of the 1990s, when companies borrowed heavily to expand fiber networks based on demand projections that never materialized. The shale oil sector in the 2010s followed a similar pattern, with debt-funded drilling waves that eventually ended in defaults when commodity prices fell. Analysts emphasized that both episodes involved massive capital expenditure fueled by optimistic revenue expectations. The difference now was scale. The AI-driven borrowing wave dwarfed prior cycles because it intersected with power grid limits, water resource constraints, and global competition for advanced chips dominated by China, the world's largest economy. As pressure mounted, some policymakers in Washington floated a contentious idea. Reuters reported that certain industry executives were pushing to loosen restrictions on advanced chip exports to China, arguing that allowing Chinese buyers to purchase high-end processors could generate dollar inflows large enough to relieve near-term credit stress for U.S. firms. Proponents framed the move as a liquidity release valve selling chips abroad to bring fresh capital into a domestic system stretched by unprecedented AI capex demand. Critics saw the proposal as dangerously short-sighted. Exporting top-tier processors could help fund the current build-out, but it would also provide overseas developers, particularly in China, with more powerful tools to accelerate their own AI industries. The Wall Street Journal noted that U.S. national security officials had previously warned that high-end AI chips could enhance rival capabilities in ways that were difficult to mitigate once the hardware left the country. The proposal pitted immediate liquidity needs against long-term geopolitical strategy. Let's stop for a moment because this wasn't the plan anyone expected the system to follow. Credit that once fueled broad-based economic growth was being pulled into a single sector. Physical resources were approaching critical thresholds, and the core liquidity mechanisms that stabilize dollar markets were showing signs of strain. At the same time, the world's largest economy, China, was building its own AI and data center capacity at a pace that challenged U.S. dominance. Bloomberg reported that Chinese firms were rapidly expanding domestic GPU clusters, while, also investing in water-efficient cooling systems to help deal with the same resource constraints confronting U.S. operators. The Financial Times noted that China's state-aligned infrastructure banks were scaling loan facilities for AI-related projects, making sure domestic liquidity stayed stable, even as global markets tightened. This parallel movement created a deeper contradiction. The United States was pulling credit from across its economy to chase AI infrastructure, while China was leveraging centralized financing to expand without squeezing domestic credit markets. U.S. regulators watching these divergences warned that imbalances could become systemic if the borrowing trend continued. By late 2025, the evidence was mounting. Treasury auctions saw occasional soft bidding as funds rotated toward AI bonds. Corporations outside the tech sector told WSJ reporters that capital expenditure plans were being postponed due to higher borrowing costs. Community banks in the Midwest told Bloomberg that small business loan demand remained stable, but approval rates were falling because liquidity had shifted upstream. Households saw higher mortgage rates even as wage growth cooled, and credit card interest rates hit new cycle highs. Utilities faced similar pressures. Grid planning budgets ballooned as operators prepared for load increases tied directly to AI centers. DOE projections suggested that in regions with multiple hyperscale clusters, power demand growth could exceed broader economic growth by wide margins. Municipalities struggled to reconcile data center water needs with residential consumption, particularly in drought-prone states where surface water variability was rising. The system was tightening from every angle. AI companies kept borrowing because the infrastructure arms race demanded it. Investors kept buying because yields were rising even on top-tier debt. Lenders kept reallocating capital because market depth began clustering around a single, rapidly expanding sector. And beneath all of it, money market fragility kept flashing signals. The Fed's corridor tools absorbed liquidity shocks, but the frequency of usage told its own story. Reserves that once seemed ample were now sensitive to credit cycles tied to corporate issuance. As liquidity moved, the cost of short-term funding occasionally wobbled, leaving analysts uneasy about the potential for a more abrupt repricing. What emerged was not just an AI boom, but a pressure system. Bond markets stretched, power grids strained, water sources depleted, and dollar liquidity fluctuating in ways that challenged the stability of the U.S. financial system. The contradiction powering the boom, unlimited investment chasing limited physical resources, became harder to ignore. The question was no longer whether AI would transform the economy. The question was whether the foundational systems, credit markets, water supplies, power grids, and the money supply infrastructure could withstand the weight of that transformation without breaking. Because history showed that debt-driven expansions rarely slow down gently. They either accelerate until they hit resistance, or they fracture under their own scale. And right now, every indicator suggests resistance is approaching faster than policymakers expected. Whether the system bends or breaks will depend on how quickly credit can rebalance, how rapidly infrastructure can expand, and whether liquidity can keep pace with borrowing demands measured in hundreds of billions of dollars. If those conditions fail to align, the bubble won't simply burst. It will unwind through the very channels, water, power, liquidity, credit, that keep the broader economy running. Which leaves one final unresolved question. In a race powered by chips, water, and borrowed dollars, what collapses first, the infrastructure built for AI or the financial system built to fund it? Please like and subscribe. Leave your thoughts in the comments. Your support helps us grow. Thank you.